Hi, I'm Chloe Carruthers and I'm with Barry Norris, the fund manager of the Argonaut Absolute Return Fund. Barry, it was a tumultuous January with markets suffering their worst falls since March 2020. How did the fund do and what were the main drivers of performance?
So the fund didn't quite do as well as what it did in March 2020, but it was still a very good month with the fund rising 5.5%. The winners in the fund were unsurprisingly in the short book, particularly amongst very expensive US stocks. So things like the EV truck maker Rivian, which last quarter had only $1 million of sales, but was valued at the start of the month as $85 billion. That fell by over 35% during the month. Then our old friends, the COVID vaccine producers, BioNTech and Moderna, also fell around 30% because investors questioned whether these companies would continue to sell their vaccines in as bigger volumes going forward, given the milder Omicron variant and the fact that the vaccines don't provide sterilizing immunity.
What is causing the volatility in markets and is it over now?
What's causing the volatility is the end of an era of cheap money as central banks have to withdraw that stimulus to fight inflation. We think that the bear market will only be over when central banks turn less hawkish. That could be in 6 months, that could be in 6 years. Many investors believe that inflation will peak around the summer, largely due to easier year-on-year comparisons. We disagree. When I started my career in 1998, that was a period where we had a big sell-off in markets caused by the Asian crisis and the blow-up of big hedge fund LTCM. At that point, central banks pumped liquidity into financial markets, and you had this incredible blow-off top in growth stocks in 1999, which subsequently led to the dot-com bubble bursting in 2000 as central banks raised interest rates. And I think something similar is happening now in that COVID was like the 1998 event where central banks did more stimulus, the Fed did more QE in 18 months than they'd done in the previous 12 years. And you had this incredible fiscal stimulus all at the same time. That led to a blow-off top again in growth stocks and long-duration assets. And I think what we're seeing now is that asset bubble, if you like, is being pricked as the central bank punch bowl is being taken away. Moreover, such was the stimulus that I think a lot of it hasn't yet got into the real economy. So particularly in the US, a lot of the stimulus that was announced has yet to be spent. So that suggests to me that the stimulus will still be entering the real economy at a time when central banks are tightening. That probably means that the Fed is going to continue to be behind the curve on inflation. And that means that the real economy will probably hold up a lot better than many financial assets. So after a 12-year bull market in asset prices, which were dependent on zero interest rates and quantitative easing, I think many investors have either become rich and complacent or have never experienced anything different. So, we certainly believe that the rules of investing have changed because the cost of capital is no longer free, and investors who can adapt to those new rules will, I think, thrive in the new environment.
What kind of return profile can investors expect in the future from the fund? And how should these investors use the fund as part of their overall portfolio?
Well, I think it's important to say that we are not just betting on markets going down. We're not a negative beta fund. We have a long book of stocks that we like and think that the share prices are going to go up. And we hedge that with a short book of stocks that we think are going to go are overvalued and are going to go down. So, we are able to perform in in all market environments. It doesn't mean to say that our investment process is foolproof or that the fund will deliver positive returns every day, but it does mean that our return profile isn't dependent on a positive market direction like most other funds. So the fund should be used for investors that want to hedge their exposure to the market and want to diversify their exposure away from the market direction. So I would caution anyone about buying the fund for a short-term trade, or a belief that our investment process is going to make them money every day. I think that the fund should be used just as a long-term diversification process. But at the same time, I would say that most investors are currently over-concentrated in growth equity managers and growth stocks. And I think at the moment, at least, we provide the perfect antidote to that style risk.
Are there any parts of the market that you are bullish on?
Well, we see significant potential in stocks that will benefit from reopening at the end of the pandemic. If you remember, we were cautious on this last year on our belief that vaccines weren't the solution. But I think certainly if you believe, like we do, that the pandemic's over, then things like airlines, cruise liners, they should do a lot better this year. And that should also lead to stronger demand for transportation fuels. And I think that brings us neatly on to what the part of the market that we're really bullish on, which is energy. So we see demand increasing this year, but we also see the energy industry as being very supply constrained. So major oil companies have cut their capital expenditure in half. They're discovering only 20% of the oil that they're currently producing in terms of new reserves, and replenishing their reserves. And therefore, when you get demand up but supply down, and really at the moment the only place with any spare capacity in the oil market is Saudi Arabia, that should lead to a much higher oil price, and that should be obviously good for oil stocks, but not necessarily good for the wider economy or the wider market in terms of those inflationary concerns. I think longer term, we see a structural shortage of cheap energy. And a lot of that's got to do with decarbonisation and the race to zero carbon. If you think about renewable energy, when the wind doesn't blow or the sun doesn't shine, as the energy can't yet be stored, all of renewable capacity needs to be backed up by more reliable generation like nuclear, hydro, or natural gas. And since we're not really investing in nuclear or hydro, that means that we're dependent on natural gas, and that will mean that the natural gas price will stay very high. So we think that with demand up, supply down, and on top of that, this structural decarbonisation, we think we're in an era where we're going to have a bull market in fossil fuels and a bear market in everything else. And that's what gives us the most impetus, if you like, in our view, that the risk is that we return to a 1970s type scenario.
Great. Thanks very much for answering those questions.
Thanks, Chloe.
All right.